Welcome to the daily video update. This is Being Prepared Tuesday, June 21st. Happy summer, where we'll talk about what happened in the markets today and then see how things look for Wednesday, June 22nd. And yes, I'm doing all of this take one. That's probably going to be the way I'll do things for the foreseeable future. And so I've switched from using PowerPoint over to Google Slides. So you'll get to see some great mistakes probably at no additional charge, mind you. And since I'm doing this all take one, you'll probably hear me slip up and cough and clear my throat and all kinds of wonderful things. That's also at no additional charge. So just some entertainment value. Have some things just to go over briefly before we get into things. I did post a video over the weekend where I explain, it's kind of a lengthy video. My gosh, I just would not stop talking. And I just explain what I'm trying to do. The program is now open for membership. So please, if you have a chance and a desire, go ahead and go to YouTube and you should be able to find that video. If you can't find it for some reason, let me know and I can send you a link. There will be no daily video on Friday. I have some things going on that day and the logistics just don't allow me to prepare a video. I'll have one for Thursday, I'll have one for Monday, but not for Friday. And I will do the weekend video and the intermarket analysis video. But just that one Friday daily video, I just won't be able to do. Over the weekend, it's kind of nice when you have an extra day to look over some things. I ran across a newsletter and it's free. There's a gentleman that was being interviewed on a YouTube video, and he's kind of saying a lot of the things that I've been noticing in the market. And he offered his email address here. And so I sent him an email and now I'm on his list. It doesn't cost anything, doesn't ask any questions. His name is Dan Byrd. In fact, I have a couple of charts later on that I'll show you, and you might find that helpful. And even though I'm on the mailing list and I'll be talking about some things, you can also get this email, possibly read it before you watch the video or after, and hopefully it'll help you put some things together sometimes, because there's some things that he talks about and he has his own way of doing things, just like I have my way of doing things. But when you look at a couple of different sources, that might end up helping you. There's also a helpful video. Last week, I mentioned where I was watching a video where it kind of brought some things together that I've been noticing. Well, that gentleman's name is Tom Mowley, and he's with stockcharts.com. All the charts that I have, well, most of the charts that I show you come from stockcharts.com. He's also part of another website called earningsbeat.com. The videos are on YouTube and you should be able to locate them. I can also watch them as a member, so I kind of get access to a few more things since I belong to stockcharts.com. But a lot of their videos, they just stick up on YouTube as well. They have a channel, Stock Charts does, and you might find that helpful. All right, so let's go back and talk about what happened on Tuesday. We had a pretty positive day. We did have a real gap higher at the open. We gapped above R1, which was at about 37.09. And we even went above R2 right at the open at 37.44. And a lot of people sometimes ask me, why do you have an intraday chart? Well, because that's where you get to see things. And that's why I watch the futures that trade pretty much 24/6. And that's where you get to see what's really going on, because a day like Tuesday, most of the action was right at the open. We didn't really see what was going on as the day unfolded. Now, it didn't turn out to be all that much, but that's why we want to look inside. Then as the day went on, we pretty much just drifted sideways, but we were able to hold on to the gains. Now, the market is very oversold. And so, yeah, a bounce like this should not necessarily be a surprise. What we're trying to figure out now is this a dead cat bounce before we get set to go lower? If you ask most people, you probably get about 98% will say, yeah, this is just a little pause before we're going to dive deeper. Well, I've got some charts here just to present the other side. that show that maybe some good things might be developing. Doesn't mean that they will, and it doesn't necessarily mean they're happening right now, but there are things that we want to keep an eye on. But we were able to hold on to the gains as the day went on. Going into the close, we were up 2.48%. Not a great deal of difference was made, even with a pretty good gain like that, but still an up day nonetheless. Volume was below average. Now we might be getting back into that below average scenario that we've been dealing with. And the technicals, yeah, we're still negative. And in some ways we could bounce more because there's still some oversold indications that we have. In other ways, we could start tanking lower because we were up on Tuesday and we're off a few of the oversold conditions, and we could begin our slide downward. And just so you know, when I started recording this, I looked at the futures and they were down, my goodness, like 1.75%. So that's pretty hefty. Now that could always change. I'm recording this about 6 hours before the market even opens. So it can change a lot, or it could stay the same or get even worse. Who knows? But things were negative. People are still really fixated on inflation and interest rates, and I address those pretty much in every video that I do, which falls over into growth concerns, which also feeds into a new thing that I've added at the very end, the recession fears. We're hearing that more and more now, and the battle's going back and forth. Some people say, yes, we're going to be in a recession. No, we're not. Some are saying it's 50-50, 60-40. Take your pick. If it happens, it happens. If it doesn't, it doesn't. We just need to know ahead of time, okay, what are we looking for? Because there's a lot of clues that we're getting right now to suggest that we might be going into a recession. And that would really shift the picture that we're looking at right now, because a lot of people are based in the stock market anyway, are basing things on the fact that we don't go into a recession. Of course, all the geopolitical concerns, those are still in the background, and then earnings as they come out. So what are some comments? Are we just having a dead cat bounce after being oversold, or have we made a bottom? There's a few folks, this Dan Byrd and Tom Mowley, the two gentlemen that I referred to you, especially Tom, he thinks the bottom is in and that we're going to really go up from here. Not necessarily right away, but he's not throwing all of his money into the market all at once. He is. The other guy, Dan Byrd, he's starting to put some money to work more incrementally. So now that's the debate going on. Stocks and interest rates both advanced at the same time. It's always interesting. You think we've got this figured out when interest rates go up and stocks go down and vice versa. Well, they both went up on Tuesday. The 10 to the 5 yield curve is still inverted. The other issues that we were having, they're worked out, at least for right now. That could change at any time. Fear is still really extreme. We had existing home sales that came out, and this is starting to show a real slowdown in real estate. They decreased 3.4% on a month over month basis. And it was adjusted to an annual rate of 5.41 million. They expected 5.40, so it actually sold a little bit more than what they expected. But when you take all the sales together and compare it to a year ago, we were down 8.6%. So it's starting to show some signs of weakness at least in the real estate area. Our trend is still negative. I have our bias mostly negative, but also mixed because of the up day that we had on Tuesday. But overall, our momentum is still quite negative looking back over the last 2, 3, 4, 5 days. Let's go through the day's session. We are still extreme fearful, which could be positive, but we've been camped here. We're not seeing a lot of capitulation right now with this. And you can tell that I don't have the same tools. Don't I draw such a pretty perfect circle right there? Yes, that's me drawing a circle. But we're below 25, but we're not necessarily getting a V bounce out of this. It just means that a lot of people are very skeptical right now. The VIX declined on the up day, and we had gotten up over 30 with the VIX, both on the line chart and on the bar chart. But overall, they both ended up declining on an up day, which is not surprising. The VIX of the VIX also showed a decline, so fear subsided a little bit. The Ulcer Index continues to climb, so that's showing that there's still quite a bit of fear in the market. We're down 21.87% from the all-time high. Here's the 1 day of the equity put call ratio, and we had really been spiking up a lot. Well, with the up day, that really came down. So you had fewer people buying puts, or maybe more people buying calls. Here is the 5-period moving average of that. It also shows that we are declining. Here's the longer term look. And this is what I was pointing out as one of our possible positive scenarios, even though I don't have it in that section. It's not very often that we spike above 0.8 with the 5-period equity put call ratio. Well, we did spike up over that. We've come back down since then, but a lot of times this will mark either a bottom or around the time of a bottom when we spike up that high. So that's one thing we're keeping an eye on. We also had the updated version of the Ridex bear bull ratio, shows that fear is picking up just a little bit. We're at 0.12. This is one of the charts that I got from Byrd, and I've seen this chart before, but not with all the words on it, because this chart can be kind of confusing. This tries to describe the economic cycle. So it compares what the stock market is doing with what the economy is doing, and then how different sectors rotate during the whole process. Feel free to just pause this and look at it for a while. But the takeaway that I'm getting from this is he believes we're right here, that we're into the late bear market, early recession, and that we're bottoming right here, and that we could go ahead and start to turn up. Now, most people think that we're like right here, where we still have a long ways to go before we hit bottom. So you're going to get different stances. People are going to feel different about things. But I just wanted to bring this to your attention. And then here we have the equity cumulative flows. It's actually showing us that people are still putting money into stocks, but where they're taking it out of is bonds. That's where we're seeing flows really coming out, is the bond market. Here's another chart, and I don't know if you can see a chart behind this or not. Apparently it didn't work out the way I wanted to. This is a chart that I showed you before with the bullish sentiment. And that's the black line here, which shows that we are pretty extreme negative. And the blue line is the S&P 500. So a lot of times when we get down to really low levels like this, that can spark some kind of a bounce. We're not necessarily extreme as far as this sentiment chart is concerned. When we drop below this second dashed line and get down into this area, that's when we're extreme negative. Well, we're negative right now, so there's a real negative bias, but we're not necessarily extreme when looking at this chart. We're seeing some money flowing back into tech. That's the growth stocks. That's what pushes the indexes higher. That's when we really go up. And if we start to see money coming into tech, that could be something positive for the market overall. Then looking at the NASDAQ, and not only does the S&P have a forward PE ratio, price to earnings ratio, but so does the NASDAQ 100. And as the NASDAQ 100 has been coming down, it makes the valuation decrease. So we're currently at a PE ratio based on forward earnings of 18.6. And that's kind of between being expensive and being fairly priced. If you take the more absolute value of between 15 being fairly valued and 20 being overvalued. Another thing that's kind of interesting is there's been a huge increase in the number of searches on Google saying, what's a recession? Or using that as a keyword. Just like after Brexit happened, you had the biggest search terms the day after the vote was, what is the EU? And Britain had just voted to leave the EU. But you had a lot of people that didn't even know what it was. So I just thought this would be something kind of interesting, that a lot of people are concerned about a recession. Also, retail sales, they're starting to really drop off. And this is the year over year sales where we actually went negative, but we bounced up a little bit here. Could this mean that we're going to be heading into a recession? Support and resistance areas. Here's the intraday chart. So right over here on the side are all of the intraday support and resistance levels that are used to calculate, that I calculate many different ways. And again, I tend to use the standard ones. And here they would be the dark blue that you see right here. I don't know if this helps anybody or not, but I try to make this available. Looking on a daily chart, we're still above S2. So we have that support level below us. We bounced up. Here's where I have the circle. Now, if we really start to go up, we have overhead resistance at S1 at about 38.59. There's other resistance areas, or if we fall, there's other support areas, but these are based on the daily pivot points. Here's the machine gun chart, just showing that we're kind of in between two pretty significant levels of either support or resistance right now. Here's a little cleaner look at that same chart here. And then here's just using the standard, DeMark, and Fib pivot points. And again, these stay the same for the whole month of June. The only thing that changes is there's another bar that's added each day, or a candle in this case. Now, this is a Fib chart that I haven't shown in a while. I showed this a couple of weeks ago where I drew a Fib retracement from the high that we set in late March down to the low that we set in May. And we had been hanging out at this 38.2% level for quite a while before we really started to tank. And then we dropped below that. Well, if we start coming back up, what was support now becomes resistance. So we might have a little bit of trouble at about the 38.06 level. And again, I draw these lines on here, so they may not be exact numbers. I just try to eyeball them here. Also, in this other Fib chart, going back to the low that we set back in 2021, we were able to break above that resistance level. So that could be seen as positive. Are we going to be able to stay above this level, or now are we going to drop down if we have a down day? Here's another Fib level showing that we have overhead resistance at about 38.25 to 38.29-ish, right around in there if we continue to go up. And there's also some support at about 35.14 if we head down. Here's the weekly chart. Now, we got back above that one Fib resistance level on the daily chart. If we have a chance of going higher, can we get back above about 35.08 or 35.06 if you round up? This is a longer term Fibonacci retracement level that we broke. Now, can we get back above it? The sectors, every one of the sectors was up, with energy, which just got hammered last week. It did the best on Tuesday, and discretionary, which has also been very weak, as well as tech. So a lot of the areas that have seen weakness for 2022 saw a lot of strength on Tuesday. The communication sector, which is still kind of been struggling anyway, it was up the least at 0.46%. And here just shows you how, how energy is still the only sector that we have that is positive on the year. Technical alerts, they were all positive. The S&P was able to get back above 3,700. That's the only positive one I see for this. But we had some different sectors, like consumer staples had a BPI cross above 20. Utilities, the same thing. They crossed above 20 in communication. The NASDAQ was able to retrace some lost territory. And the NYSE also had a BPI. So we're seeing some bullish percent indexes, which, remember, those measure the point and figure buy signals when we're going up, and they measure the sell signals when we're going down. That's more of an internal measurement. So that could suggest things are a little bit more positive, especially when we see them across many indexes and sectors. Intraday. Now, this is what we were looking at. And I usually bring up a 15-minute chart here, but because of the day off, the futures were still trading on Monday and I was still watching them. And I wanted to include that where we were up okay. We were up 0.5 to 0.75% on Monday. Then leading into Tuesday's session, we saw some real strength. Europe was up and doing quite well. And on the back of that were the S&P futures. And we ended up opening pretty strong. And then this first bar that's shooting up, that's the gap open right in New York. So it was pretty positive during the night. And then the daily chart, where I had to change the size of this. I call this a smokestack day, where we gapped up above R1, even went to above R2, and then just kind of, this is like smoke blowing out of a smokestack. We just kind of drifted for the rest of the day and didn't really do much after the open happened, but we ended up being up 2.48% anyway. Looking at our trend, buying pressure really came down, selling pressure came down, buying power increased, which rolled over our ADX a little bit, but it's still negative overall, and the red line's on top, so we still have a negative trend. Looking at breadth, need to do a lot more than what's already been done, but at least we turned up a bit based on price and volume. The AD ratio also bounced up, but it's still negative because it's below zero. New highs and new lows continue to fall. Now, it'll take a day or two for these to turn if we see follow through buying, because these are moving averages. Accumulation distribution is also negative, but turned up slightly. Looking at some short-term charts, we may have overdone it on a one-day basis. Going back with the rate of change from Tuesday to Friday, we had a pretty significant move. The force index, not necessarily extreme now, still negative, but showing some improvement. The rate of change going back 10 periods is still extreme negative. The Swinland trading oscillator based on price and volume, it's kind of been leading us a little bit. It turned up a couple of days ago. Well, it still continues to go higher. McClellan oscillator coming out of an extreme negative reading, but still negative since it's below zero. Stoke RSI is no longer extreme, as is the Williams %R. The 20, 50, and 200 period moving averages, they're trying to turn up, but all of them are still pretty extreme. Stochastics trying to come out of being oversold with the short term, turning up a little bit with the intermediate term, and still just kind of a little bit sideways with the longer term. Looking at some intermediate charts, and we have a little chart hiding behind us here. The PMO continues to decline, and we're declining based on price and volume. So things are still negative. We turned up a little bit with those PMOs that are rising, trying to turn over with the number of buy signals, and we're still kind of, well, we're sideways pretty much with those PMOs that are above zero inside the S&P. The CCI 14 and the CCI 20 have come out of extreme negative territory. The standard deviation still shows that we've moved pretty far, pretty fast. So that might slow things down a little bit. The Sean trend meter remains extreme negative, even though it turned up slightly. The Chaikin oscillator is still looking a little bit more positive. Chaikin money flow, it's kind of dancing around in the zero line right now. Volume really dropped off on Monday, so that's why we're seeing this black line really roll over currently. Plus, we had that huge spike from Friday due to quadruple witching. The vortex is declining a little bit with the selling, advancing a little bit with the buying, but still negative overall. Summation index is declining based on price and volume. All of our oscillators are still negative and really haven't had much of a chance to even try to turn up at least yet. Here's the BPI, where we're getting pretty extreme in the S&P. We saw a lot of BPI signals in other indexes and other sectors. Well, this is the one for the S&P, and this is pretty extreme. The only other time we're able to get down to this level was at the COVID plunge. Ultimate oscillator is coming out of being extreme negative. The rate of change 50 is still extreme negative, but turning up. Money flow index continues to decline. It's a little slower. TTM squeeze continues to decline. Looking at our different charts, the Heiken Ashi actually has an open white candle here, but that could redraw if we have any significant price movement either way, either up or down. The Kegi chart is still negative because it's red. The 3-line break, there wasn't enough of a move to change it. And I didn't bring up the point and figure chart because nothing changed there. The Elder's Impulse, it has switched back to neutral. And for some reason, the SPY chart didn't make it on here. It's showing the same thing. So the SPY is also neutral right now. The SAR continues to be negative. The go, no go system is still deep purple. Long term, we're still coming off a very extreme reading with the 50. We're trying to bounce up on the 150 as well as the 200. The rate of change going back 250 periods. This is a pretty long-term chart. I wanted to bring this up because we're kind of coming down here to where we were during the COVID lows. And here's an even longer look going back to 1980, just showing that we could go lower. But I just want to give you some perspective on that as well. The special K continues to decline. Looking at the broad market, the diamonds are neutral and the Qs continue to be neutral. Here's the possible positive scenario. And I wanted to switch it over to that part of the presentation, but Google Slides was just starting to really mess up. I drew a couple of additional lines on here. Let's first look at where we are right now, where we're making a lower low in the S&P. And that's what I originally pointed out, where we're seeing a positive divergence when you compare the Qs and the spiders, discretionary in the spiders, large caps growth against large cap value. There's a positive divergence kind of going across here. What I did over the weekend is I noticed here where we're making a higher high in the S&P, but notice we're seeing a negative divergence with these same 3 charts down below. So that should have told us that we're going to have some trouble in early 2022. So this is telling us, even though we're going down, that things might be getting better. And also have some additional charts. The large cap growth to value, even though we're making lower lows with the S&P, we're seeing a positive divergence with the large caps, mid caps, and small caps. We saw just the opposite of that, back in late December, making higher highs with the S&P, but we're seeing a negative divergence here. And these are not trend lines right here. I'm not very good at trend lines, and they're so subjective. I'm just drawing these lines here just to point something out to you. So they're not trend lines in the purest sense. Another thing that could be positive is that the stocks that are below their 50-period moving average were still extreme negative. So you figure that there's 505 stocks. There's only 7 of them right now that are positive, that are actually above their 50-period moving average. And this shows the mid caps, which we're seeing the same thing, even though it bounced up a little bit more. And then later on should be the small caps. Okay, that one got mixed up in the wrong order. The dollar declined about 0.25% after having a really good couple of days last week. The dollar to the S&P 500, they still have a pretty strong inverse relationship. And that's what kind of gave me some hope. As I was watching the futures, I was also looking at the dollar index. The futures were up and the dollar was down. So I'm like, okay, I have a little more confidence in that. If we get to the point where both are up and both are down, one thing's probably going to have to give at that point. But that doesn't always mean it's going to be that way. It's just the way it's been lately. Oil was up to 109.52. we're actually getting to the point where stocks and oil are starting to go more in the same direction where they did just a few days ago, have a pretty solid inverse relationship. The gold futures were kind of dancing along the 200-day moving average. The gold ETF is below the 200-day moving average, and here's a longer-term view of the ETF. Silver is really continuing to have some trouble, and here's the longer-term view of that chart. Bitcoin, it actually got down into the 17s over the weekend, but it's now back up at about 20 or so. And of course, everybody's got an opinion, and even the people that said we're going to 100K, and they're coming out and trying to justify their actions and all that. But it's just been a bloodbath for people that have been involved in cryptos, in Bitcoin more particularly. And it's kind of sad. A lot of people have been really hurt by that. Then this is another chart that I found just showing, it's called a capitulation in crypto. This is just the history of what's happened. Those of you that are a little bit older, you might remember when gold really spiked up in the late 70s and early 80s. Then we had a real surge up in Japan in the late 80s. Then Thailand had a real bubble in the mid 90s. We got into the tech bubble. This is the dot-com boom and bust. Then here's the housing thing here in green. Then we had some issues in China that led to a big bubble. Then 2013 through 2016, there were a lot of biotech companies that were all the rage, and then they kind of fell apart. Then I believe this is supposed to be the FANG stocks here, the red ones that have had some trouble. But then up here, you have Bitcoin, where it really spiked up. Oh, and then ARK is on this chart as well. And it just shows, and in my classes, I have a breakout class where I go through the history of bubbles, and we go all the way back to the tulips. I mean, there's nothing new under the sun, and people have been doing this for hundreds, if not thousands of years. They get caught up in something, and no matter what it is, it leads to a bubble, and then that bubble ends up bursting, and people are just kind of standing around wondering why. So looking at bonds, the corporate bonds actually declined a little bit with treasuries. We saw a bit of a decline in the bond ETF. I don't know why these charts are like this. The world bonds also declined about 0.5%. The correlation between the S&P 500 and the 10-year still pretty strong, moving in opposite directions. Tech in 10-year, whoops, and this thing just changes on its own sometimes. They're also having a pretty strong inverse relationship. And then the only inverted yield curve right now is this one second from the bottom, where we look at the 10 to the 5. Looking at the interest rates themselves, we broke above this 100% retracement with the 10-year. Now we're coming back down. Could it be acting as resistance? I'm sorry, support as we come back down. This also is kind of showing the same thing, just a little bit different way, where we broke through here. Now we're starting to come back down. Will that be support? 30-year also going above the 50% retracement. It hasn't really come back down to this fib level yet. And treasuries, after really falling a lot on Friday, started to turn back up on Tuesday, pretty much across the board. Our possible positive scenarios, try to say that one. This is one of them, where this is looking at the S&P 500 with the stocks that are above their 200-day moving average. So that's the longer term moving average. It bounced up a little bit, but we're waiting to see if we have more of a sell-off. Is that going to go down into this area, which quite often will mark a pretty significant bottom if you compare it with the chart up above. This is another chart, and this is where I'm like, I don't know if I want to draw these. This means trend lines, because how some people draw the trend lines and how I would do them are completely different. But this is like a trend channel. And this goes all the way back to the lows in 2009. And I just drew the first trend line, I just drew on the bottoms here, from the 2009 bottom to the COVID bottom. And then I did a parallel chart trying to get the majority of the highs in here. And then I tried to draw another line kind of in the middle. Well, look at where we're at right now. And look at what happened when we came down to this midpoint before. So it's at least this is worth noticing. Yeah, we can drop a little bit below it. And during the COVID plunge, we dropped all the way to the other line, but that line wasn't there yet. Here, we're right back in about the middle. So could that also provide some support? Here's Dan Byrd's chart. Kind of the same thing. His lines probably look a little nicer than mine. He's got it all rainbow colory and everything, but kind of showing the same thing. He has this a little bit up off of this dotted line, but this chart was drawn after Friday, where mine was updated after Tuesday. It just looks like a newspaper all just splattered all over. This is another chart that he had. When I prepare the presentation, these other charts back here don't show up. And if I try to get rid of them, they're not there. So I don't really know what to do with this. What he did with his chart, and if you get on his email list, he'll probably send you this. He's looking at the VIX on the top, and then here's the S&P, and then those stocks that are above their 50-day moving average, which we've been talking about. And then he's also looking at the NASDAQ 100 and those stocks that are above their 50-day moving average. And he's seeing when they all line up like they are right now, that has often marked a significant bottom. So that's kind of the scenario that he's putting forward. Our 2-year spike, can't really say yet because it went up again on Tuesday. So we can't really look at this one, at least yet. The correlation between the S&P and the 2-year shows that they're still pretty strongly inversely related, where interest rates are going up as stocks going down. Well, even though they both went up yesterday, that's why we saw this turn back up. We don't know how long that's going to last. This sector staple was up, but not as much as the rest of the market. So that means that this spike actually turned back down just a little bit. So right now, the main spike right here in the middle, the one that we picked out a week or two ago, that's still looking viable right now. We need to see more follow through price action for this to be a legitimate signal. Just one day isn't going to do it. So what's our outlook? The technicals, they're negative and we're bouncing after being oversold. At least that's what we did on Tuesday. And there are some possible positive setups. Sentiment is still extreme negative. On Wednesday, we have the weekly mortgage applications index coming out. That's pretty much all. So it's a pretty light week as far as economic reports. But Fed Chair Powell will be speaking in front of the Senate Banking Committee. And usually what happens is his remarks are prepared beforehand. He goes and he reads and he testifies in front of the House and then in front of the Senate. And what he reads is usually the same. It's the Q&A where things might get a little crazy. And so that's why they like to broadcast that, just in case something weird is said or some way that Chair Powell gives an answer, the tone of his voice might spook the markets or make them exhilarated, one of the two. We have all these different geopolitical events. They're pretty much all the same. Russia, Ukraine, China, and I understand and remember, I teach English to kids in China, and some of them are being locked back up now. They can't leave their houses where they were starting to go back to school. So that's starting to change. Inflation, interest rates, margin calls if we continue to fall. Oil is a big deal. Earnings, Fed speak. We're getting a lot of that with the Fed Chair Powell speaking. Japan, and then I've added recession fears to this whole list as well. So what are our scenarios? What could keep us going down? Pretty much everything I just said. The technicals, yeah, we're still negative. Our oscillators are negative. We're below all the moving averages, but we've been bouncing from an oversold condition. The big thing is that going to continue, or are we going to see a bounce from here? And that's kind of bringing up scenario number 2. The technicals are oversold. There's a real disbelief. And just as kind of it was interesting. When I went to my YouTube channel, not my YouTube channel, my YouTube homepage, and I have a lot of different stock market videos that I could watch, and they're almost all of them. Don't buy stocks. This is the beginning of the end. Everything's going to go down from here. And you can sometimes use that as an indicator itself. When you see everybody saying the same thing at the same time, then that's why when I start looking for the opposite, maybe not to happen right away, but at least to be prepared to happen. And then our possible positive scenarios that I went through, those could, if they continue, we need to see follow through. The different technicals, they're really negative right now. So we have to rely on some pivot points, fib retracements. I took the moving average thing out of here. And then different previous levels, which may act as support if we fall or as resistance if we go up. We are not neutral at the current time. So that's not a viable scenario. So our conclusion is the S&P is negative, but possibly rotating back to growth. That's the positive divergence that we're seeing on those charts. It's the opposite of what we were seeing in December into early January before things started to go bad. So we just have to see, is that going to continue? In the short term, we're negative, but at least on Tuesday, we bounced because we were oversold. You can kind of say the same thing about the intermediate term, where we are still negative in the long term. So thank you. I hope that you have a really good Wednesday, and I'll prepare the next video for after Wednesday's session for Thursday. And yes, I'm trying to just eat up a little bit of time here. Actually, I'm not using end cards on these videos currently, so it really shouldn't matter.